Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 22nd of May, 2022. As always, this is general commentary and doesn't take your personal situation into account. And make sure you hang around till the end. I've got some fascinating sentiment graphs that help explain what's going on with the market mindset, the mindset of all those investors out there. I'm going to explain what it means and what it could mean for what the market does next. So hang around for that. We're back with that a little bit later. I think you're really going to enjoy it. Now, with that said, let's go over to our first chart. So we've got the S&P 500 on the screen, and it's been a really interesting week. We're seeing some early signs through here that we're getting that bounce that we've been speaking about over the last few weeks, and potentially it's getting underway now. And what makes this even more interesting is that it's happening off a Fibonacci retracement region. What I'm going to do, I'm going to press this chart. So what I want to do, I want to get the whole advance from these March 2020 lows. So you've been watching this for a while. You'd be hearing me talk about how I think that this current decline we're in is a correction of this entire advance. And so when we're measuring a Fibonacci retracement, we want to use what we believe is a complete move, whether it be a intermediate move or an extended move or a short-term move, whatever time frame it is that you're looking at. So I'm looking at the retracement from this entire move, which I believe is a complete move. And it's interesting when we look at this and we put those Fibonacci's on, we've come right back down to the 38.2% retracement, which is a very natural place for a rally to occur from. And we can also put our measured move on to see how this is played out. We can measure from the high down to this swing low, back to this swing high. See, the market pretty much got down to where the measured move was suggesting as well. So we've got a couple of points suggesting this could be the place where it'd be very natural for that bounce to occur from. So what we can do now, let's look at this bounce in a bit more detail, and we can see we've got a resistance zone which comes in around 4,100, just through here. So this was a support area until recently when the market broke down. Now, support region after it's being broken becomes a resistance band. So that's an upper boundary for the market to sort of potentially retest over the next week or two. And what we can also do, we can also put the Fibonacci retracement levels on for the most recent decline. I'm going to use this move here because that to me looks like it could be a complete move. So we can measure that out, those Fibonacci retracements on. And what we find is that the Fibonacci region comes in it starts right where this resistance band starts. So it's going to be interesting to see whether the market over the next week, whether it can retest into here and then potentially break above there. And if it can break through this region, then we're looking at levels towards maybe 4,200, 4,300. Now, it's entirely possible, I think, that sort of scenario could play out, given that we're coming off really oversold levels where we got down to a couple of weeks ago. That's going to be interesting to see how that plays. Now, what I want to do now, I'm going to look at have a look at the volatility index of VIX. So I'm going to put this on the same chart. Just down here, it's going to come in below. So this is the volatility index, which is known as the VIX. And this is interesting to look at because what we can see here, we've got some divergence going up. So divergence is where you have market making a new low. You can see we had a low here and then a lower low here. Then we look at what the VIX did over that same period, and it hasn't. It didn't make that same new. It should have made a new high. You'd expect with the market making a new low, the VIX would have made a new high. That's not what it did. It wasn't able to get back to that previous peak, which it had a couple of weeks earlier. Then we can also look back further. We can see this region through here. That was a swing low, broke down here, made a new low. But then we look what the VIX did. The VIX hasn't been able to quite get back to that peak. So we kind of double divergence there, which suggests to me that the market around here, it is oversold. And as I've been saying, it's a natural place for some sort of relief rally, some sort of reversion to the mean type rally, which brings back up closer to those moving averages. So it's going to be, and if volatility does continue to come off over the next week or two, well, that becomes a potential tailwind for the S&P in terms of trying to recoup some of these heavy losses we've seen over the last month or so. So let's now go over to the Nasdaq, and this is a really interesting market, a really interesting index to look at, because it's had one of its biggest and most persistent sell-offs in history through this period through here. It's actually been down 7 weeks in a row, which is really quite extraordinary, because you've got to go back to 2011 to see a similar decline. So let's just do that. Let's just look back at 2011 and see what happened through there. And it was this period through here. This is a 7-week decline. It was only a 10% decline. Fell for 7 weeks, but only lost 7%. Then after that, it did have a strong rebound. There were some more losses afterwards, but nonetheless, a sequence of continued declines led to a significant rebound. And then before that, you've got to go back to the GFC, find a run where the market has come off as much as it has this time. So we're down 25% in the last 7 weeks in the Nasdaq. You've got to come back into this period here during the GFC. So from this point down to here, that's a 7-week decline of 25%, which is round about what we've had now. This one added a little bit more sting to the tail because it had an eighth week of decline, and that was a nasty drop. So you can see that we are historically stretched. Doesn't often get to that 7-week decline mark. Could go further, but I'm not thinking that we're set up for a GFC style sell-off over the next couple of weeks. Prior to that, you've got to go back to the .com period to find another 7 week, actually an 8-week stretch of losses. So they're pretty rare. They're pretty rare to get this big sequence of losses. And so, look, I think based on that, we can say that by any historic standard, this market is stretched to the downside. And you look at the internals of the Nasdaq, and like what are all those stocks doing inside it? And so this is the Nasdaq 100 we have here on the screen. But when we look at the Nasdaq composite, so the Nasdaq composite has over 3,000 stocks in it. And almost half of those stocks are down by over 50%. So there's really been a lot of upheaval and a lot of damage done in that index. And that means that at some point you do expect that relief rally where you do have that rebound higher. So I want to talk a little bit more about this chart which we have on the screen, being the Nasdaq 100. And we've got that classic zigzag decline, which you can see. This is typical of so many corrections. You get the ABC, you get the zigzag decline, and then you do the measured move, which we've done previously. That all plays out nicely as well. Look at this. The measured move comes right back to the market's low from last week. Now, if you're wondering what this measured move is all about, it's a technical technique that we use to estimate where a market could get to. So it's simply measuring the length of this leg of the decline. We wait for the next swing high, then we project that previous distance down again. That gives us that target zone. So it's come right to the target zone at the moment. And also, let's just put on those Fibonacci retracement levels again, just to complete the picture. And you can see we're right down here on this 50%. 50% retracement zone. So we'll come back to the 50%. We've completed a measured move. Looks like we're getting some signs of a rally. So as I've been saying, I think this is a natural place for a swing low to occur. Swing low is what we'd call a temporary low, not necessarily a lasting low, but a temporary low, somewhere where we do get some sort of rebound in the opposite direction. And I want to stress, I'm not calling this a final low, and I'm not calling a start of a new bull market by any stretch. I'm just talking about the potential for a technical bounce or a bear market rally. There's another name for it, a bear market rally in an index, which by historical measures is at extreme levels. So let's go through some more gauges to sort of see where this market could be, some more indicators. So let's start by looking at some market breadth indicators, because these can be really helpful in gauging where a market is. And a group of indicators which I always keep a keen eye on, which you've often seen me talk about, are these number of stocks above their moving averages. So let's start with this one here. So this is the number of Nasdaq stocks above their 50-day moving averages. And what's interesting in the last week is we've started to bounce. So this blue band here, this is 15 and below. When we get to here, it's showing that only 15% of stocks are above their moving averages, above their 50-day moving averages. And so what we've seen it get down to around 5-6%. We're getting that rebound. Let's compress this a little bit. Let's have a look. Let's have a look at a little bit more data, because I always like to get lots of data points. Lots of data points gives you a more robust feel for what's going to happen, rather than just looking at what's happened in the last. And what we see when the market gets down into this region, so through these points here, this was during the COVID period. Some more touches here. Once it rebounds from there, it tends to build up a bit of steam. It doesn't necessarily mean that it's going up to new highs. Like here, we had a bounce in this period, then it came back down for a retest. So you can get that as well. Here we got a bounce. This is quite a meaningful bounce. It went for several weeks. Then we came back and got a retest. I think we've got the potential to see this continue to rally, and maybe we see a retest later in the year. Let's not go there at the moment, because that's not where we're at. We're just looking at what's likely to happen, what we think could happen over the next few weeks. And then we can look at the number of stocks above their 200-day moving average. Now, this is also fascinating. I'm going to put this one on a weekly chart. And so when we compress this, get a bit more data, so we can go back to 2007. Well, this is the GFC period through here. This is really interesting. When you look at these touch points, typically only comes into this zone for maybe that's 3 weeks. We've got 3 weeks there. Move along. These were only like 1 week's touches. Like we got here, got the rebound. Then a few weeks later, we retested. But it doesn't stay here long. You can see it doesn't stay here long when it comes in. GFC was a bit different. It came down and it stayed in this region for a while, but it quickly started to, almost immediately, it started to move higher. So stocks don't stay below their 200-day moving averages en masse for a really long period of time. It doesn't linger in here. So you look at where we are now, and we've been in here for a couple of weeks, and it looks like we could be starting to rebound now. So look, another sign that maybe we're actually now in that rebound. Can't rule out that we're not going to come back and retest this at some point in the next few weeks or next few months. I'm not sure whether I'd be comfortable saying this is all over yet, but it does look like we're oversold, we're overextended. We need to rebound higher for look. I think you'd look for at least a few weeks of relief rally. And look, if you're getting value from this, please hit that like button. Let Google know that you like it, and please leave a short comment, just something like, "Hey Jason, thanks for the video. really short and sweet, just tells YouTube that people are watching, they're engaging. So YouTube will show more people, and I'll keep making more videos. So that's really helpful if you can please do that. And also, if you haven't, jump over to my website at some point, just have a look. This is my Motion Trader website, motiontrader.com.au. It's all about trend following, all about using the trend to identify momentum in the market, how to use your trailing stops to stay in stocks when they're moving in your favor, but then using exit levels to get out when they go against you. And I've got this resources section here. I've got all sorts of things. I've got market outlooks and videos and articles, and it's all designed to help you become more confident, more capable. It's about passing my experience onto you. So, we talk about how to invest in bear markets, knowing when to sell your shares, mistakes to avoid, all sorts of stuff, trailing stops. So look, come over, check it out. May find it helpful. So now let's get back into our charts. So next up, I want to have a look at the ASX 200. Here we are here, ASX 200. So let's go to the daily chart to start with on this. And look, the ASX 200 has really been struggling to gain momentum this week. It has really been making heavy weather of it. There's resistance through here, through around 7,200, which really seems to have the market pinned at the moment. So, and you can see we've got these bands from previous episodes we've recorded. So we've got the triple top up here, the triple top resistance. Then we've got this support band, which the market is rebounding off at the moment. But whilst we're getting a rebound, it's not really gaining a great deal of momentum. So I want to jump over to the hourly chart, just get a little bit more detail. So where are we? So let's get this 7,200 level. Let's just mark that in for starters. So that's our resistance point. That's our resistance point through there. Market's really butting up against it now. I think it's going to break to the upside. I think it's been struggling, but I think it will break above there. And all the traders who have gotten short through this period, this is a natural place through here to have their stop losses. So if you're short, you don't want to potentially ride the index all the way back up to the highs. You've got to have an exit point. So a natural place to have your exit point, an obvious place to have your exit point, would be just above these this resistance band. So should the market get above here, I think there can be some short covering. There could be some investors who see the momentum and want to start getting excited about thinking, oh, maybe they should have bought the dip a bit earlier. They come in. We could get a little bit more momentum coming into the ASX next week. Should we break that resistance point? And look, I'm not expecting great things at the moment, but I do think we can see some higher levels come into play over the next couple of weeks. And I want to quickly have a look at the ASX Small Ordinary. So this is a small cap index for the Australian market. And unlike the ASX 200, which has really been held quite well by the big resource stocks like BHP and also banks like the Commonwealth Bank, those big heavy cap stocks have been holding the market together quite well. In the small caps, it's been another story. They've really had a pretty nasty experience through here over the last couple of months. And I know I'm feeling it in my portfolio because I mostly trade the smaller end of the market. So it's been, if you've got smaller stocks in your portfolio and you're wondering why is my portfolio making a heavy weather of it while the ASX 200 is kind of looks like it's holding in there, it's because it's the smaller end of the market has really struggled during this period. The buying interest has dried up, and if you try to sell stocks, like I've been trying to unload some stocks during this bounce, and it's hard to unload stocks. There's not a lot of buying interest coming in at the smaller end of the market at the moment. And what I think, though, I think we might see a continued recovery. I don't know how big this recovery is going to be, but I think we can see some recovery from where we currently are. Interesting to overlay this with the Russell 2000. This is the American small cap index. And so let's just put that on there. So this orange line is the Russell 2000. And you can see that there's actually like a really good correlation through this period here. Now, if this scenario of a rebound in the US market continues to play out, I think we're going to see the Russell also get a bit of a bid tone return to it, get some more upside in the Russell. And with this correlation we're seeing, you'd expect that also to flow through to the small ordinaries. So look, I think for the small ordinaries, the one to watch is probably the Russell more so than the ASX 200. So I do think there's a bit of upside potential there. And so let's look. It's going to be interesting to watch how that goes this week. I think it's going to be an interesting one to watch. Now, what I want to do now, I want to just look at a couple of really interesting graphics I found during the week when I was going through some of the people who I follow on Twitter, because you can always find some fascinating stuff people put up for others to use, and you could call these contrarian indicators. I'm always fascinated by this type of thing because they can give you some really good clues into the mindset of others, the mindset of the investing world en masse. And when a topic becomes fever pitched, it's often a time to consider the other side. So if everyone's talking about one thing, they're not talking about. So let me show you this first graphic. Here it is. Here. So let me just enlarge that. So this is showing the number of news articles during the week which contain the words bear market. So above here we've got our S&P 500, and this is the count on the number of articles mentioning bear market. So you can see we're currently right up there, and this is 10 years. This is 10 years worth of data. So it's a significant period. Only time there was more bear market mentions was near the lows of the COVID crash, but there have been several other spikes higher. And what's interesting, when you look at where all these spikes are, they all coincide with lows in the market, or in some cases they're just pullbacks. But they do tend to coincide with lows in the markets because people, the media will start talking about bear markets, usually not before they happen, but when we're in the thick of it. When we're in the thick of it, it's often coming to we're getting towards the tail end of it. So again, I don't know whether this means there's a final low. My feeling is it may not be a final low, but it does feel like we're nearing that point of maximum pessimism, at least in the near term, and we get that relief rally. Suggest something else to suggest that maybe that bounce is actually starting to unfold now. Now, the next graph I have for you, this is one of my favorites. It's in the style of that favorite. There's this famous magazine cover from the 1970s. It was in a magazine called Newsweek, and the cover was The Death of Equities. It was 1979, and it was about, I think it was within a year of the mega bull market of the 1980s taking off. So it was sort of like your contrary indicator. It was saying, no one was ever going to buy shares again, and lo and behold, they did. So this time it's Barron's. Barron's is the magazine cover. So it's really interesting. Just go through this with me. So this is the New York Composite Index near the highs before COVID, and Barron's comes out with this big yellow cover, 30,000 on the Dow, a big upward rising trend. It's very, 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 very bullish in the way it captures your attention. So playing on people who are like looking for Dow 30,000. Wow, it's going to keep going. Sure enough, market fell. Of course, no one knew COVID was happening, but nonetheless, that was the sentiment of the market at the time. The time sentiment was very bullish. Fast forward into the depths of the COVID crash, and the crisis playbook was the new title, was the new magazine cover. So again, gets very bearish after the meat of the falls are already in place. Move forward a couple of years, 18 months, 2 years, and we've got a bull marching higher. Big money pole. again, looks very bullish. So I haven't read the articles. I don't know the contents of the articles. They could be quite balanced when you read it. But that's not the point. The point is getting inside the psychology of the move, the psychology of the mindset of the market, and the editors are trying to draw on that at the time. So they're using overly bullish or overly bearish images to get attention. And now, finally, where we are now, don't get mauled. You got the bear claws, grating down the paper. Is this a swing low? Is this a temporary low? Is it a final low? Time will tell, but it does feel like it could be some sort of a low. So, really interesting times. Really interesting times to see how this is going to play out over the next few weeks. So, look, how do you play all this? It's look, I think we're still playing defense. Yes, I think the US indices appear oversold, and yes, I think we could be starting a meaningful bounce or a bear market rally. But I still think this could still take a while to fully play out. When I look at the charts for companies like Apple, like Microsoft, like Alphabet, they're broken down out of big uptrends. And these were key players in the bull market. And I think if we're going to get the bounce we're talking about, I think that can well and truly happen. But I think it's still going to take time for these stocks and the market in general to work through this. And what I think if we do get a rebound, it could provide an opportunity to potentially tidy up a portfolio that's holding some stocks that maybe should have been sold a few weeks ago. Maybe you've got stocks in your portfolio which you're uncomfortable with. You're going, look, they're down a long way. What am I going to do? I don't really want to sell them now. And I know that can be emotionally difficult to do. But perhaps if we got a rebound, maybe that provides an opportunity to tidy up some of those stocks maybe you wish you had sold earlier. And I'm still using rebounds in the market to lighten some of my holdings as well. So it's a natural thing to do during these periods. Look, I still think it's best to avoid buying the dip at the moment, particularly in stocks which are below their 100-day moving averages. I think that's where the accidents happen. The accidents happen when you get stocks when a stock's below its 100-day moving average. That's when the bad stuff can happen. That's when the market tends to get blindsided. So I'm very wary of buying the dip. I think at the moment we're in an environment where it's sell the rally. We could stay in that sell the rally moment for a little while yet. So we are going to work through this period. I know it's a bugger. I know your portfolio is probably hurting. Mine is. I think most people's are. Very few people make money during these periods, but they are part of the cycle. Unfortunately, we can't do anything other than get through them. And that's what I'm here to help you do. I'm here to help you get through with as much of your capital intact as possible, with your emotions intact. And then when the time does come, it'll be like looking for the new opportunities and then having the courage to get back in after a bear market and take the new opportunities when the time is right. But I don't think we're there yet. Let's keep watching. We will get there, and hopefully I can help you find that point of getting back. So thank you for joining me. Fun talking to you as always. Look forward to coming back next week. Please give me that like and a short comment. Till next time. See you then.